Hello, everybody. One of the common questions I get from friends and peers entering retirement is, what asset classes do you hold for retirement? Of course, it's never phrased like that, lah. More often is, should I buy a condo and collect rent, or should I be buying dividend stocks and live off the dividends? In this video, I'll compare the three asset classes that I commonly hear: real estate, dividend stocks, and equities. And I will share specifically for me and my wife why equities form the main part of our risk assets and why we have chosen not to rely on real estate and dividend stocks. But before we dive in, the usual disclaimer: this is not financial advice. I'm just sharing my thoughts and approach. So let's get started. When I think about retirement portfolio for my wife and I wanted to do two things. First, provide a security blanket to fund our retirement lifestyle. For us, that means safe assets like cash and cash-like instruments like T-bills, money market funds, and short duration bonds. Second, hedge against inflation. That way, when my favorite wonton mee costs $10 or $12 a plate, we can still afford it. To achieve this, we need some exposure to risk assets, things like equities, real estate, gold, and even crypto. Now, let's talk about real estate. Singapore property has seen tremendous growth since independence. My parents' generation has plenty of stories about it, but you hear old folks talking about the days that you buy a HDB flat for 30,000 and sell for $500,000 a couple of decades later. But looking ahead, I'm not so sure. I'm a science person, not an economist, so my forecast is not worth much. What I would like to share is the three things that we don't like about real estate. Number one, concentration. With today's prices, most of us can only own one or two properties at most. That makes timing, location, unit layout, everything really critical. Not our cup of tea. Number two, management. It's not as hands-free as it seems. People see that you say that you just sit there, collect rent, but in reality, there's tenant selection, there are vacant periods, late payments, and wear and tear to deal with. So if you are really sway, can even end up on newspapers, right, with your version of horror stories of scams, tenants from hell, etc. Number three, liquidity. Our core retirement principle is to die with zero. We want to spend down our assets meaningfully. Real estate locks up too much capital and doesn't fit this philosophy. So for us, real estate is out. Now, dividend stocks. To be honest, I don't like picking individual stocks. I'm really bad at it, full stop. And even when I try to fit it to my investment style and look at dividend-focused ETFs, the so-called dividend titans, they got sexy names like this, their total returns are at best similar, but often pales in comparisons with my favorite, which is the MSCI World Index. More importantly, if we want dividends, we can't spend down the capital without reducing those payouts, like real estate. So that doesn't fit with our goal of dying with zero. Which brings me now to equities. So why equities? For me, it comes down to what I call the three R's of equities: return, risk, and reversion to the mean. Together, they make equities a powerful long-term risk asset that we feel comfortable holding during retirement. Let's talk about returns first. Historically, equities have delivered around 5 to 8% per year on a broadly diversified index like MSCI World. Of course, the future returns may vary, but there should be enough buffer to stay ahead of inflation, which policymakers usually target at around 2 to 3%. Let's move on to risk. Let me start off by making this clear. Equities are risky stuff. You can see drawdowns of up to 50%, and the pain can last quite a while, sometimes for up to 10 years. There's a quote from Morgan Housel in his book Psychology of Money, which I want to share here. Volatility is the price of admission. The price inside is superior long-term returns. So over the years, I have learned to live with this risk. It took mistakes, discipline, and plenty of practice. Today, I'm comfortable with my ability to understand and manage the risk. Equities makes this easier because the risk comes in smaller chunks, usually thousands or tens of thousands of dollars, unlike real estate, where a single decision can mean millions. This flexibility allows me to adjust and rebalance gradually, spread transactions over time, and avoid timing pitfalls common in property investing. The result? Less monitoring, less stress. Exactly what we want in retirement. Now let's move on to the last R, reversion to the mean. This last R gives me the most comfort, and I'm often surprised it's treated like a footnote instead of a headline point. Every crisis feels different, whether it's the dot-com bust, the global financial crisis, or COVID. Yet, over time, markets have always drifted back to their long-term averages. Take a look at this graph. Even if you endured a decade of painful returns, say negative 3.2%, leaving you 30% underwater, history shows that the following decade could more than make up for it, with your money tripling over time. This idea of reversion to the mean is what helps me sit through the storm and stay invested. As a lifelong Liverpool fan, it reminds me of a line from our club anthem. After the storm, there's a golden sky. And that especially resonates with me. Of course, we don't intend to spend 10 years of retirement in the storm. My wife will never agree. The point is, knowing downturns will happen allows me to prepare for them. That's why I've built safeguards into our asset allocation, which I'll share in greater detail in a future video. So in summary, equities suit our temperament. We are not chasing the highest returns. We are happy with, say, 5% a year with our risk assets, as long as it means we don't run out of money and we can enjoy the short time we have on earth doing the things we want, make money work for us rather than the other way around. More importantly, equities allow us to align with our principle of dying with zero. For us, that's non-negotiable. That's it from me. I'd love to hear your views. What's your preferred retirement asset class? And do you have, like us, any non-negotiable conditions for your portfolio? Please leave it in the comments below. Until the next time, remember, sometimes the best form of aging is just aging normally. Bye bye.